Getting a mortgage, it's got to be one of the biggest financial steps you'll ever take, right? But how do you really know the advice you're getting is in your best interest? Well, today, we're pulling back the curtain on a super important rule designed to protect you, the loan originator compensation rule. Believe me, this rule totally changed the game and made the mortgage industry way fairer for everybody.
It's a pretty shocking question, isn't it? But here's the crazy part. Before this rule came along, the answer could have easily been yes. The whole system had these built-in incentives that could actually reward a loan originator for sticking you with a more expensive loan. Let's dig into how that actually worked. You see, back in the day, the way some loan originators got paid was tied directly to the terms of your loan. And that created some really serious conflicts of interest. We're talking about hidden incentives that put regular people, just like you and me, at risk. Okay, so the main culprit was this thing called a yield spread premium. Basically, it was a bonus, a kickback paid to the loan originator for giving you a higher interest rate than you actually qualified for. Just let that sink in for a second. The worse the deal was for you, the bigger the bonus was for them. It's just wild. And this slide right here just lays it all out perfectly. Imagine you have two identical borrowers. Borrower A gets a fair 4.5% rate, but for borrower B, the originator just bumps that rate up to 5.0%. That little 0.5% difference, that's what created the yield spread premium, a bonus that went straight into the originator's pocket. Over the life of a loan, that could cost you tens of thousands of dollars, all just to fund their bonus. So as you can imagine, this whole setup led directly to a practice called steering, and it's exactly what it sounds like. It's when a loan originator would guide you or steer you toward a loan that wasn't the best one for you, simply because it paid them more. Obviously, something had to be done about this. So the Truth in Lending Act, you might know it as TILA, was amended with the Loan Originator Compensation Rule. The entire point was to get rid of these awful incentives and just level the playing field for you, the consumer. And you don't have to take my word for it. Here's the mission statement, straight from the rule itself. It was designed primarily to protect consumers by reducing incentives for loan originators to steer consumers into loans with particular terms. I mean, it's right there in black and white. By taking away that financial reward for steering, the rule helps make sure the advice you get is focused on your needs, not on padding someone else's wallet. Okay, so if all that shady stuff is banned, how do loan originators even get paid now? Well, the new system is actually a lot more simple and transparent. It's built to be much, much fairer. And here's the most important thing you need to know. Under the new rule, an originator's pay can only be based on the size of the loan. That's it. It makes sense, right? A bigger loan is more work, so they get paid a bit more. It's straightforward, and most importantly, it's fair. The rule is crystal clear. Pay cannot be based on the interest rate, the APR, or pretty much any other term or condition of the loan. This completely cuts the cord between how much the loan costs you and how much the originator makes. It takes away that temptation to bump up your rate for their own personal gain. Now, this rule wasn't just about setting new guidelines. It also put up some very big, very clear do not enter signs. Let's take a look at the specific things that are now totally illegal. One of the biggest no-nos is something called dual compensation. This was another one of those sneaky ways that hidden payments could find their way into the deal. So here's how it breaks down. In the old system, an originator could charge you, the borrower, a fee, and also get a payment from the lender for bringing them your business. Double dipping, basically. The new rule says, nope, you gotta pick a side. They can get paid by you, or they can get paid by the lender, but they can never, ever get paid by both on the same deal. So let's just walk through that whole unethical path of steering one more time, just so we're all clear on what's now off limits. It starts with you, the borrower, qualifying for a few really good loan options, but the originator ignores the best fit for you and instead pushes the one that pays them the most. The end result? A more expensive loan for you. The new rules are designed to make this whole scenario a thing of the past. All right, let's bring it all home. What does all of this actually mean for you when you're sitting across from a mortgage professional? Simple. This rule is your financial shield. And to make sure that financial institutions are actually following these rules, there's a really important accountability measure. They have to keep detailed records of all the compensation paid to their loan originators for a full 3 years. This creates a paper trail, so regulators can check up and make sure you're being treated fairly. So let's just quickly sum up your key protections from this rule. First, your originator gets paid based on your loan amount, not your interest rate. Second, that dangerous incentive to steer you into a more expensive loan,
It's gone. Third, no more dual compensation. They can't get paid by both you and the lender. It all adds up to a mortgage process that is just fundamentally more transparent and a whole lot fairer for you.
See, knowing this stuff is power. It changes the whole conversation. You're not just asking what rate can I get, you're having a much more informed discussion about your options. So the next time you're looking for a mortgage, what are you going to ask to make sure your interests are truly being put first?